What is going on, investors? Welcome to my channel. This is the Frugal Investor. In this video, I am going to analyze one of the most talked about stocks in the stock market today, which is Disney. With that said, let's get right into it. On this channel, when I am analyzing a business, I look at five things, which is the business itself. Number second is the financials. Number third is the leadership. Number fourth is the P by E ratio and the forward P by E ratio. And number fifth is the cash and the debt that the business has. Let's start with number one, which is the business itself. Disney as a business has two main sources of revenue, which is Disney Parks and Disney streaming services, which is Disney Plus, ESPN, and Hulu. Disney parks are very well established and a great source of revenue generation, while Disney Plus, ESPN Plus, and Hulu, these are still new and upcoming businesses, growing parts of their business. The customer base and customer loyalty for Disney is the most interesting thing going on for this business. It is also their backbone and their strength. I say that because their customers are not in one country, but they are well spread out across different locations from China to Japan to Paris, all across the world. 2 to 3 whole generations of humans grew up watching Disney and can relate to Disney cartoons no matter where you go in the world. So this is kind of a legacy thing. This is what people do. They watch Disney when they're growing up. This is kind of a legacy thing that is ingrained in humans, which makes their business and their customer base really, really strong. Also, the way they are coming out with Disney Plus, with Hulu, they are not dead in the water. They're competing with giants like Netflix. They are taking on this new century, this new era, with great improvisation in the ways of doing business. And that is what makes me so bullish on Disney for the long term. We looked at the business, the customer base. Now let's look at the numbers. The revenues for this quarter of Disney was $17 billion as compared to 11 billion from the pandemic year, which is the last year. It is up by almost 45% from the last quarter. Now, most of their revenue is coming from Disney Plus and Hulu and ESPN Plus from these streaming services, which is $12 billion, while only $4 billion is coming from the parks. Now, the reason for that is the parks are still not operating at full capability. There is a huge room to grow. Before the pandemic, in 2019, the parks were generating a revenue of 6 to 7 billion per quarter. So right now it's at 4 billion. So they have at least 4 to 5 billion dollars room to grow, which gives them more revenue once they open in full swing, which I'm expecting by the last quarter of 2023, they will be generating that number. And in the next 3 4 years, I will not be surprised if the parks go neck to neck with the streaming services revenue. We currently is 12 billion, and I will not be surprised the parks are generating that much revenue in the next 3 4 years. So they have a huge upside in that department. Net income for this quarter is $918 million, while the last quarter during the pandemic they were losing $4 billion. I personally expect the net income to be at $5 billion for the last quarter of 2023. So the business is great, spread out across different locations all across the world. The numbers look great. In USA, they are in Florida and California Disney parks. Now let's look at the leadership. Let me give a round of applause to the leadership at Disney. Seriously, they deserve so much appreciation. They cut their dividends the last year and they went on heavy with Disney Plus with the new series like Mandalorian, and they invested heavy with Disney Plus and they did a fabulous job. It worked out so well. I applaud them for cutting the dividend because Disney was a well-established business with their parks, but when during the coronavirus came and with the advent of Netflix, it was getting really hard for them to see Disney in the upcoming years. How will they perform in the upcoming century? And they did such a fabulous job with Disney Plus. This shows that Disney is not dead in the water. They're fighting. They are coming back. They're improvising. They are competing, and that's what makes the spirit of this business so strong. It's a 98-year-old company. 98-year-old company, and they are in such spirit. They're taking over this century so rapidly and so fast. It is great to see a business do that, which is one of the main reasons I'm so bullish on Disney. Bob Chapek and Rob Iger, they have done a fabulous job in managing Disney and in improvising the business and in coming out with new products in this new century. I would not give this business to handle to anybody else other than these two people. Let's look at their P by E ratio and the forward P by E ratio. The current P by E ratio for Disney is 102. Now the P by E ratio is very high. The price by earning ratio for Disney is very high as compared to that of Netflix, which is 52. But Disney is investing a lot of money into their business, and the parks are still not open up to full capability. So I understand the P by E ratio. The reason behind such a high P by E ratio is because one, one of the main sources of income, which is the parks, are still not open at their full capabilities, and also they are investing so much money back into their business. So which makes sense. It is a growing business, and that justifies the high P by E ratio. Disney still has a lot of things to prove in the next 3 to 4 years. The forward P by E ratio for Disney is 80. That is, they're trading at 80 times multiple of their forward earnings. And I expect this number to improve in the next 3 to 4 years. Once the parks open back up, they're generating more revenue with Disney Plus. They're coming out with more content. So I'm very bullish on Disney in the long term, even though the P by E and the forward P by E is very high compared to Netflix. If we look at their stock price, in the past 1 year, the stock is up by almost 35%. And in my opinion, I do not expect the stock to go way higher or way below 175. This is the trading range from the last 7 to 8 months, and I expect it to stay at that range. In my opinion, Disney at 175 is a great holding point, and if it goes below 175, goes to 172, 173, then it is a great entry point in for Disney, and it is a long-term play. It is 5 to 7 years play, and I think it will continue to do really, really well once things are in full swing. We looked at the business, we looked at the leadership, we looked at the financials, we looked at the P by E ratio and the forward P by E ratio. Now let's look at the amount of cash Disney has on hand and the amount of debt the business has. So the amount of cash that Disney has is $16 billion, and the amount of debt that Disney has is $56 billion. So that is not a bad position. Com- Seeing all the low interest rates, this much amount of debt is not a bad position at all. But by the end of 2023, I would expect both the cash and the debt to be at a comparable number. If the cash is 16 billion, the debt should be either 16 billion, 20 billion, 25 billion, but no more than 30 billion, just in my opinion. So that was my 2 cents on Disney. We went over the business, the financials, the leadership, P by E ratio, and the amount of cash and debt on hand. As I said, Disney also cut their dividends last year, which is obvious because they want to invest more in growing Disney Plus, Hulu, and all these other streams of income. My stance on Disney is bullish for the next 5 to 7 years. I'm holding Disney and I will buy more if it goes below 175. Currently, I own about 36 stocks of Disney, and this is one of my long-term plays. Thank you guys so much for watching this video. If you're still around till the end of this video, I really appreciate all of you guys watching. If you find value in my content, please don't forget to like and subscribe to the channel. Thank you so much for watching. This is the Frugal Investor signing out.